Investing can be a rewarding and fun activity, but it can also be risky and frustrating if you don't know what you're doing. Many investors, especially beginners, tend to make some costly errors that can hurt their performance and jeopardize their financial goals. But don't worry, we're here to help you learn from the best and avoid the worst. In this video, we'll go over the most common investment mistakes that people make, explain why they are bad, and give you some actionable tips on how to avoid them for better investment results. By the end of this video, you'll have a better understanding of how to invest smartly and confidently, and hopefully avoid some of the pitfalls that many others have fallen into. So buckle up and get ready for an adventurous journey into the world of investing. Let's get started. Mistake number 1. Not having clear investment goals. The first mistake that many investors make is not having clear investment goals. This means that they don't know why they are investing, what they want to achieve, and how they plan to get there. They just invest randomly, hoping for the best, without having a clear direction or purpose. This is a bad mistake because without clear investment goals, you won't be able to measure your progress, evaluate your performance, or adjust your strategy if needed. You'll also be more likely to chase short-term returns, follow the crowd, or panic when the market goes down. To avoid this mistake, you need to have clear investment goals that are specific, measurable, achievable, relevant, and time-bound. These are also known as SMART goals. For example, instead of saying I want to make more money, you should say I want to save $100,000 for my retirement in 20 years by investing 10% of my income in a diversified portfolio of stocks and bonds. Having clear investment goals will help you stay focused, motivated, and disciplined. It will also help you choose the right investment strategy, asset allocation, and risk level that suit your needs and preferences. Mistake number 2. Failing to diversify enough. The second mistake that many investors make is failing to diversify enough. This means that they put all their eggs in one basket, or invest too much in one security, sector, or market. They think that by concentrating their investments in one area, they can maximize their returns and beat the market. This is a bad mistake because by failing to diversify enough, you expose yourself to more risk and volatility. If the market moves against your concentrated position, it can be disastrous for your portfolio. You could lose a large portion of your capital in a short period of time. To avoid this mistake, you need to diversify enough by spreading your investments across different securities, sectors, markets, and asset classes. This will help you reduce your risk and smooth out your returns over time. Diversification is one of the most important principles of investing because it allows you to benefit from the power of compounding without taking unnecessary risks. A good way to diversify enough is to use index funds or exchange-traded funds, ETFs, that track the performance of a broad market or sector. These funds are low-cost, easy to use, and offer instant diversification. You can also use robo-advisors or professional advisors that can help you create a well-diversified portfolio based on your goals and risk tolerance. Mistake number 3. Being emotional when investing. The third mistake that many investors make is being emotional when investing. This means that they let their emotions such as fear or greed influence their investment decisions. They buy high when they are optimistic and sell low when they are pessimistic. They also overreact to market news or events without considering the long-term implications. This is a bad mistake because by being emotional when investing, you impair your judgment and logic. You also increase your trading costs and taxes by making frequent transactions. You end up hurting your returns and undermining your goals. To avoid this mistake, you need to be rational when investing. This means that you should base your investment decisions on facts, data, analysis, and research. You should also have a long-term perspective and stick to your plan regardless of market fluctuations. You should also control your emotions by not checking your portfolio too often or following the market noise. A good way to be rational when investing is to use a systematic approach that follows a set of rules or criteria for buying and selling securities. This will help you eliminate emotional biases and stay consistent and disciplined. You can also use tools such as stop-loss orders or automatic rebalancing that can help you execute your plan without hesitation or deviation. Mistake number 4. Timing the market. The fourth mistake that many investors make is timing the market. This means that they try to predict the future movements of the market and buy or sell securities accordingly. They think that by timing the market, they can outsmart the market and earn higher returns. This is a bad mistake because timing the market is extremely difficult, if not impossible, to do consistently and accurately. The market is unpredictable and influenced by many factors that are beyond your control. You could miss out on some of the best days or months of the market by being out of the market. You could also incur more trading costs and taxes by making frequent transactions. To avoid this mistake, you need to adopt a buy and hold strategy that involves buying quality securities and holding them for a long period of time. This will help you benefit from the long-term growth of the market and avoid the short-term volatility. You will also save on trading costs and taxes by making fewer transactions. A good way to adopt a buy and hold strategy is to use dollar cost averaging or lump sum investing methods that involve investing a fixed amount of money at regular intervals or at once. This will help you reduce the impact of market timing and take advantage of market fluctuations. You can also use dividend reinvestment plans or automatic investment plans that can help you increase your holdings and compound your returns over time. Mistake number 5, following investment tips blindly. The fifth mistake that many investors make is following investment tips blindly. This means that they rely on the advice or recommendations of others without doing their own research or due diligence. They think that by following investment tips blindly, they can save time and effort and get quick results. This is a bad mistake because by following investment tips blindly, you expose yourself to more risk and uncertainty. You could end up buying securities that are overvalued, fraudulent, or unsuitable for your goals and risk tolerance. You could also end up losing money if the tips turn out to be wrong or outdated. To avoid this mistake, you need to do your own research and due diligence before investing in any security. This means that you should verify the source and credibility of the tips, analyze the fundamentals and performance of the security, and compare it with other alternatives. You should also have a clear understanding of the risks and rewards involved in investing in the security. A good way to do your own research and due diligence is to use reputable and reliable sources of information such as financial websites, publications, reports, or podcasts. These sources can provide you with objective and unbiased data, analysis, opinions, or insights on various securities, sectors, or markets. You can also use tools such as screeners, calculators, or simulators that can help you evaluate and compare different securities based on your criteria. Mistake number 6, not rebalancing your portfolio. The sixth mistake that many investors make is not rebalancing their portfolio. This means that they don't adjust their asset allocation or weightings according to their goals, risk tolerance, or market conditions. They think that by leaving their portfolio untouched, they can avoid trading costs and taxes and let their winners run. This is a bad mistake because by not rebalancing your portfolio, you expose yourself to more risk and lower returns. Your portfolio may drift away from your original plan and become too aggressive or too conservative. You may also miss out on opportunities to buy low and sell high by taking profits from your overperforming assets and reinvesting them in your underperforming assets. To avoid this mistake, you need to rebalance your portfolio periodically or when there are significant changes in your circumstances or the market. This will help you maintain your desired asset allocation and risk level and align your portfolio with your goals. Rebalancing can also enhance your returns by forcing you to sell high and buy low. A good way to rebalance your portfolio is to use a rule-based or a threshold-based approach that involves setting a target asset allocation and a tolerance band around it. For example, if your target asset allocation is 60% stocks and 40% bonds, and your tolerance band is 5%, you would rebalance your portfolio whenever your actual asset allocation deviates from your target by more than 5%. You can also use tools such as automatic rebalancing or robo-advisors that can help you rebalance your portfolio without hassle. Mistake number 7, not reviewing or updating your plan. The seventh mistake that many investors make is not reviewing or updating their plan. This means that they don't monitor their portfolio performance, evaluate their progress, or make changes to their plan if needed. They think that by sticking to their original plan, they can avoid making mistakes or missing out on opportunities. This is a bad mistake because by not reviewing or updating your plan, you may overlook some important issues or developments that could affect your portfolio or goals. Your portfolio may become outdated or inefficient, or your goals may change over time. You may also fail to learn from your successes or failures and improve your skills or strategies. To avoid this mistake, you need to review or update your plan regularly or when there are significant changes in your circumstances or the market. This will help you keep track of your performance, assess your progress, and make adjustments to your plan if needed. Reviewing or updating your plan can also help you identify and correct any mistakes, optimize your portfolio, and achieve your goals faster and easier. A good way to review or update your plan is to use a checklist or a template that covers the key aspects of your plan such as goals, asset allocation, risk level, performance, costs, taxes, etc. You should also compare your results with relevant benchmarks or peers, and seek feedback from experts or mentors. You can also use tools such as dashboards or reports that can help you review or update your plan easily and effectively. Thanks for watching. Kindly like and subscribe to this channel for more wealth and financial tips.